In the year 2000, the average Brit earned more than 3 times what the average Pole did. Hundreds of thousands of Polish plumbers, builders and nurses poured into the UK chasing higher wages. Fast forward to 2035, just 10 years from now, and the picture could be completely reversed. On current trends, the typical Polish worker could be earning more than their British counterpart. The UK economy will still be larger in total size, but per person, Poland could be ahead. A country that was once seen as poor and post-communist could soon pay higher wages than the nation that once ruled a quarter of the planet. How on earth did this happen? And what does it tell us about where both countries are heading? This isn't migrant bashing or British bashing. It's economics doing what economics does, rewarding countries that get the big decisions right and punishing those that get them wrong. And right now, Poland is getting a lot more right than the UK. Buckle up. The story is remarkable. Let's start with the numbers, because they're almost unbelievable. In 2000, UK GDP per capita was roughly £18,000. Poland's was about £5,500. The gap was enormous. By 2024, UK GDP per capita is around £38,000 in purchasing power parity terms. Poland's has shot up to roughly £34,000 and is still growing much faster. Several reputable forecasts, including from PwC and the OECD, show Poland overtaking the UK on GDP per capita sometime in the 2030s if trends continue. Wages follow productivity with a lag, but the direction is clear. Polish average wages could genuinely surpass British ones by 2035 to 2040. Just 10 to 15 years ago, almost 1 million Poles moved to Britain for work. In another 10 years, the traffic could be going the other way. So how did Poland pull off one of the fastest catch-up stories in European history? First, it started from a very low base. 45 years of communism left Poland with obsolete factories, empty shops, and a shattered industrial base. When the wall came down, simply privatizing, opening markets, and adopting Western management practices delivered huge, easy productivity gains. It's the same reason South Korea, Taiwan, and Ireland and Estonia all rocketed forward after liberalization. There was decades of pent-up potential waiting to be released. Second, Poland has been extraordinarily good at attracting foreign direct investment. Companies like Volkswagen, Fiat, LG, Intel, Mercedes, and Toyota have built massive plants there. Poland now produces more televisions than any other country in Europe, is the biggest bus manufacturer on the continent, and is becoming a serious player in electric vehicle batteries. Stellantis, BMW, and Isra are all investing billions in Polish EV and battery factories. Third, geography and geopolitics suddenly work in Poland's favor. After Russia's invasion of Ukraine and the West's desire to friendshore manufacturing away from China, Poland is perfectly placed, inside the EU, close to Germany, its biggest customer, with good roads and rail, and wages still lower than Western Europe but much higher than Asia. It is becoming Europe's new workshop. Fourth, EU membership has been an absolute game changer. Since joining in 2004, Poland has been the largest net recipient of EU funds in history. Between 2014 and 2020, it received 86 billion euros in cohesion funds. The 2021 to 2027 budget gives it another 76 billion euros. That money has built motorways, railways, airports, sewage plants, universities, the basic infrastructure a modern economy needs. The UK, by contrast, was a net contributor and now gets nothing. All of this has produced growth rates the UK can only dream of. Poland has averaged about 4% annual real GDP growth since 2004. The UK has averaged 1.7% since 2008 and closer to 1.1% since the financial crisis. Compound that difference over 20 years and you get dramatic convergence. Now let's turn to the UK side of the story, because this isn't just about Poland doing well. It's also about Britain doing disappointingly badly. The UK's problems are deep and structural. The first big blow was the decline of North Sea oil. In the 1980s, it brought a tax bonanza that pushed the pound up, crushed manufacturing, classic Dutch disease, and allowed Margaret Thatcher to cut income taxes rather than save the windfall like Norway did. By the early 2000s, production was already falling off a cliff. Today, the North Sea is basically finished. Promises to max out remaining reserves are largely symbolic. There just isn't much left. The second pillar that collapsed was finance. The Big Bang in 1986 turned London into the world's leading financial center, and the sector grew explosively. By 2007, financial services were contributing about 10% of GDP and an even higher share of tax revenue. Then 2008 happened. The crash hit London harder than almost anywhere else. Banks stopped lending, bonus taxes collapsed, and the sector never really recovered its previous dynamism. A huge growth engine went into a semi-permanent stall. Third, the response to the crisis was austerity. From 2010 onward, the Cameron-Osborne governments slashed public investment to close the deficit. Public sector net investment fell to almost zero for several years, the lowest in the G7. With interest rates at rock bottom, this was the perfect time to borrow and build railways, hospitals, grid upgrades, housing. Instead, we cut. The result was chronically low demand and the weakest productivity growth in the developed world. Fourth, Brexit. Whatever your view on the principle, the version we got has undeniably damaged trade. UK goods exports to the EU are down about 15% since 2019 compared with what they otherwise would have been, according to the Office for Budget Responsibility. Uncertainty crushed business investment, which has been the lowest in the G7 for most of the last decade. Many firms have quietly moved operations to Poland, the Netherlands or Ireland to stay inside the single market. Fifth, we have a chronic low investment, low skills equilibrium. Successive governments have allowed house prices to rocket, encouraging households and banks to pour money into existing property rather than new productive assets. We train fewer engineers, electricians, and technicians than Germany. Planning laws strangle housing supply and infrastructure. The result is sky-high costs and constant bottlenecks. And finally, since the pandemic, the UK has seen the biggest rise in economic inactivity of any rich country, largely driven by long-term sickness. Over 700,000 more people have left the workforce than before COVID. That shrinks the labor supply, pushes up wages in low productivity sectors, and drags down overall output per person. Put all this together and you get the worst productivity performance in the G7 since 2008, flat real wages for 15 years, and a country that feels like it's stuck in second gear. It also means that, ironically, as wages equalize, one of the biggest political obstacles to closer EU integration, fear of mass migration, largely disappears. If pay is similar, free movement becomes much less contentious. Food for thought for anyone who dreams of single market rejoiners in the 2030s or 2040s. Most of all, it is a wake-up call. Britain has been coasting on past advantages for too long: financial deregulation, North Sea oil, English language, EU membership, without building the next set of advantages. Poland started with almost nothing in 1989 and has relentlessly built modern infrastructure, skills, and industry. The UK started with everything and has too often managed decline. The gap is closing fast. Whether Poland actually overtakes Britain in average wages by 2035 is not certain. But that it is even plausible tells you everything you need to know about the different paths both countries have taken. Thanks for reading. If you found this useful, please share it. The more people understand what has gone wrong and what Poland has done right, the better chance we have of changing course. Poland, for all its strengths, is not immune to risks. It sends 28% of its exports to Germany, so any prolonged German slump hurts. It relied heavily on Russian gas until 2022 and is still building LNG terminals and nuclear power plants. The previous peace government repeatedly clashed with Brussels over rule of law issues and temporarily froze some EU funds, now released again under Tusk. And growth will naturally slow as it gets richer. The low-hanging fruit disappears. But even if Poland only grows at 3% rather than 4%, that is still triple the UK's trend rate. The convergence continues. What does all this mean? It means economics is not a zero-sum game. A richer Poland is good for Britain. It buys more British services, machinery, pharmaceuticals. Polish tourists spend money in London and Edinburgh. Polish factories use British components and expertise.